Hello, fellow dividend investors. It's that dividend guy coming at you with another Robinhood portfolio update. Happy Monday. Hopefully, everybody's having a GGD, a great green day in the market. You know, I always wish the best for my viewers and subscribers. So, guys, today we're going to go over the overall portfolio value, of course, how the portfolio is performing by the metrics, our buying power, and what I plan on doing with that 185.14, as well as how the individual stocks have been performing from Realty Income all the way to T. Rowe Price. And then, of course, what my plan is for Berkshire Hathaway Class B stock. So jumping in for today, we are sitting at $55,350. Of course, that's going to change due to market fluctuation, but I'm happy to be at 55K. For the week, we are up $2,200 with a 4.24% return. Then that 1 week mark, we are up nearly $2,700 with a 5% return for the past month. Then that 3 month mark, we are at $5,300 with a 10.6% return, doing really good here in the past 3 months. Then year to date, we are up $5,500 with an 11% return. Then that 1 year mark, we are up $6,848 with a 14% return. Then all time since April 9th of 2018, we are up $20,006.42 with a 56.5% return here in my lifetime of investing. Excuse me, guys, my coffee wants attention. But overall, guys, short term, the market is a voting machine. It's all emotional. And in the long term, it is a weighing machine. So if you buy quality companies that have their earnings increase over time, and have a good competitive advantage and a strong competitive moat, then you will gain over time. That's proven here. I mean, we've had multiple presidents in the time I've been investing, as well as we've had a pandemic in 2020 and, a surge back in like 2021, economic shutdowns, political shutdowns. We had pretty much everything that can happen. And even unforeseen events coming up, and I'm still in the green. So, guys, in the short term, anything can happen, and that is a tool, really, that is a tool for investors. If something small gets overreacted on, like, I don't know, an election or maybe a new product released by Apple or a drug doesn't get patent approval from AbbVie, something like that, and people think the individual company is going down or going bankrupt, and you have you understand the economics of the business, you understand the company long term and its moats, competitive advantages, and its executive board and where they plan on going even through the turmoil. You can really take advantage, and I think I've done that in a couple of my positions, and it's really paid off. So sitting at $55,000, right around $55,300 as of right now. That 185, guys, I'm just going to let it sit. I did buy a few more shares of Apple, switched out Google for Apple. I'm happy about that move, and I'm going to keep buying Apple stock. So we'll see what happens with that 185. I know I'm getting paid by Realty Income here in a couple days. That'll add another $44, so we'll be a little bit above $200 there, about $220 to $230 after that dividend. So excited about that. Jumping into the individual holdings, starting off with Realty Income sitting at 170 at 56.04 today, $9,500 worth of market value. Average cost is $65.03. 17% of the portfolio is in Realty Income. Today we're up $48. Total we're still down $1,500 with a about 13% loss. But guys, we are up. This was up to like 21% at one point. Was at 17% for a while. And I've heard interest rates might go up. Might go down, which is better for the stock market. So interest rates are up now, but there are rumors that they might change that and drop them a bit, and that will help REITs. That will help the whole market, and that means that lower interest rates means higher profitability for companies, and that will be reflected upon in the market. And that dividend coming in a few days on July 15th of $44.71. That'll be hitting my account. I'm excited about that. And guys, that is one of the big reasons why I like Realty Income. I love their client pool. I love that they're diversifying. I do like their top 5 to 10 tenants. Really, they do a really good job of capital allocation. They're very smart about when and how they do their deals. They did take advantage of a low interest rate for quite some time and made some really good deals with that opportunity. And now that they've, the environment has changed, they've slowed down a bit on their acquisitions, but they still have really good cash flows. They have, I think a lot of people overlook this in triple net leases, but they do have an automatic annual rent increase. So even if they don't acquire new properties, they're still making more money year over year, which is awesome. It's just built into the business model. And that's one of the reasons I love this REIT. But overall, guys, I still think it's a good buy, especially for my cost average. It's just I wanted to buy Apple more than I wanted to buy Realty at this point. But it is still a great place to be putting my money for me personally. Then we got Altria, guys. This is one of those love it or hate it stocks. People love it for the yield, hate it for the business, but I like it. I smoked for a few years, and I wanted to get the Coca-Cola of cigarettes in my portfolio, get some money into, and use that money to get it out of this company. So this is really just a funnel for me. It's not my favorite company. I don't think it's going to have the best long-term growth, but it does have a high dividend. It has a low dividend growth rate, but a high yield that can compound. And I think a lot of investors overlook this. So just because something like Visa can grow at double digits does not mean something like Altria does not cannot hold a good place in your portfolio. Guys, what is it, like 9%? Yeah, about 8.5%, 9% yield still compounds year over year. And I think it can be just as effective as something like Visa, because the reallocation that it allows. So guys, I get $300 every single quarter from this company. That's a share of Visa, that's a share of Apple, that's almost a share of Berkshire every quarter. That's free. That's 4 free shares of anything in my portfolio right now for free, and sometimes even multiple shares. So I think people overlook the advantage of finding this is important, quality high yield stock. There's so many high yielders that are like 10, 12, 15%, and they're yield traps. They're companies that don't have long-term success, don't have a very long proven track record of dividend growth, and they cut it. There are a lot of REITs that even did this as well. And there are some like business development companies that do this. There are a lot of REITs that I know that do this as well. And you don't want to be in that type of a high yield company, because yes, even though you can see like, say you put $1,000 in a 15% REIT and think, yeah, I'm going to make all my money back within 3 to 5 years, and they've cut the dividend 4 times in the past 5 years, you're not going to make your money back on that. So it's important to differentiate the quality of a high yield business, because just because it pays a high yield does not mean that you're going to make your money back. It does not mean that you're going to make massive dividend returns. There could be a lot of red flags under the hood when it comes to a company like that. But I do not believe Altria is like that. They have a phenomenal dividend track record. Even though the business is declining, they do have pricing power. Like I said, I see them as the Coca-Cola of cigarettes. So I think they have, even though if it's a small growth rate, I do see them as a good opportunity to reallocate the capital that they provide and really take advantage of long-term returns. So I have 320 shares here of Altria, around $15K of market value. Our average cost is around $47.30. So we're up just a little bit. 27% of the portfolio is in Altria. Today we're up $22. Total we're up 170 with a 1% return here on Altria. So guys, again, a lot of people give me the question of, are you worried about how big some of these positions are in your portfolio? No. There's a purpose behind it. There's a reason behind Altria being 27 or a third of my portfolio. They bring in the monster amount of the cash flow that comes from this portfolio. And it is a tool. I think it's a healthy tool. I think that it's generally, I think this is one of those, sorry, my colleague's talking. I think this is generally one of those companies that people dislike, and I like it because of that. I think that's a competitive advantage for me as an investor, because a lot of people won't touch this stock. A lot of people dislike this stock, and it fluctuates. I think this is like big oil, and this is just like I said in the beginning. If you can identify the difference between this is important, a disliked business. People don't like Altria, but if you can understand that when it drops, and you can take advantage and understand that they have pricing power, that they have great brand recognition, they have a very big competitive moat in their space. They're the biggest tobacco manufacturer in the U.S. and they don't have a lot of competition in that space. They own like 47%, I believe, of the cigarette market, and then it's like 23% or more of the smokeless tobacco, pipe tobacco. They even own some of the cannabis market. So they have a strong competitive advantage. It's just tainted by people disliking the stock. And so that's an advantage that I have that a lot of people wouldn't stomach it. A lot of people would jump out of this investment. A lot of people wouldn't even hold it. And they're missing out on $300 of passive income. Now, I know it's not going to grow a lot, but guess what? Visa and Apple will. So even if this company doesn't grow a whole lot, it won't remain a third of my portfolio forever. The goal for me for this position is to use this cash flow to buy higher growth businesses. And it does that perfectly. In one of the last videos, I said, this isn't going to be my Tom Brady. This isn't going to be the Hall of Fame company that makes me a millionaire. But this is going to buy that company. This is the offensive line. This is what provides enough protection and enough stability for the portfolio to purchase a Tom Brady without putting me over my market cap for my team. So I love this business, and it serves the purpose that I bought it for. And that's really the main focus is, even if it doesn't grow a whole lot, it's going to provide me opportunities to buy higher growth companies at a frequent pace, at a consistent frequency that is going to boost my overall returns. And if I'm wrong, that's fine. I still get 8% while I wait. Then, of course, we got Coca-Cola at $63.66, 15 shares, around $950 of market value. Average cost is right around $60 per share. 1.7% of the portfolio is in Coca-Cola. Today we're down 52 cents. Total we're up nearly $50 with a 5% return. Guys, this is going to be one of the big three of the portfolio. To quote Kendrick Lamar, this is going to be one of those big positions because it's one of my favorite companies. Honestly, behind Apple and Visa, it is my favorite. When you look at companies I interact with every day, Coca-Cola is up there. I love Coca-Cola. I drink a Coca-Cola product at least once a day, if not more than that. I have switched to Prime. I will say that. I do like the Meta Moon. The white Prime is very good, and so is the watermelon, the pink one. The pink energy drink is great as well. So I do drink Prime, but I still do drink Coca-Cola. I usually go grab food before work, and I grab a Coca-Cola or a Sprite. If it's really hot out, I get Sprite. So I do interact with this company on, if not a daily basis, a near daily basis, and it will be one of those big juggernauts in the portfolio eventually. Then we got Apple at $235.54. Now, I did get a lot of flack because I bought this at all-time highs. Guys, I don't give a shit. I know Buffett sold some of his position, and I understand why he did it. When a stock is at an all-time high, it's scary to buy it. But to be completely honest with you guys, if I go back into my history with Apple, if we go way, 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 way back, you can see I bought it here at about 2 shares in June of 2018 at $375, and then I sold it at $442. So I've already made that mistake. I don't think I bought it at near time highs, but I sold the quality company that I would own a lot more of if I would have just bit the bullet and bought it. And so this is one of those companies that, even though it's at an all-time high, I've been hesitant to buy it in the past at the prices it was at, and I missed out on a lot of returns when it comes to Apple. So even if it's 52-week highs, guys, I think it has the potential to keep growing higher, and I don't want this to be I missed the boat again. I would much rather build a smaller position at an all-time high and be able to consistently purchase it and then really take advantage when it drops. I don't want to be in the position I was in for the past year with Apple, where I had a single share at at 130 or something like that. I had like $100 gain on this stock, 70% overall return, and I didn't want to buy it. I didn't want to touch it. You know what? Apple's a quality company. I believe in it long term. I do want it to be the single biggest position, and I just bit the bullet. And honestly, guys, it's never going to be the biggest position if I never buy it. And if I'm always hesitant and married to my purchase price, I'm never going to grow this position. And so the way I'm looking at it now is I want to consistently, if I can do it every month, I want to buy at least a share of Apple. And, that it will grow into a bigger position that way. But I do have cash on the side that I'm pooling together as well. specifically to buy Apple or Visa when it drops big. So if we have like a COVID situation, or if Apple doesn't sell as many iPhones or MacBooks, or maybe consumer sentiment kind of changes, maybe they have some regulatory issues, something like that, like the Facebook Analytica scandal happens to transfer to like Apple or something like that when it comes to consumer privacy. There's a lot of things that could potentially go wrong, or kind of put a blip in Apple's radar, and that's okay with me. I want something like that to happen, and I want to be prepared. But I'm okay to nibble on the stock and buy a little bit as it goes up, because then I can actually build this position. So I wouldn't mind buying like a share a month, and then if it drops to, say, my average cost is 209 right now, but say it drops to like 190 or something, and I can buy 15 shares when I own 12 to 20, then I could lower my average cost. So I'm kind of doing the inverse of what I did with AbbVie, simply because it's a smaller position and I want to build it, and I understand that even though I am buying at all-time highs now, it won't forever be that way, and I can really take advantage. I would much rather build up a position and just own my favorite company versus sitting and waiting forever. So, and I understand patience is important when you invest, but at the same time, when you only own a small fraction, say like a share of something, having a higher cost is not that big of a deal. I would wait longer to buy Apple, I think, than it's worth to wait. I think it's better to just bite the bullet, buy it at an average cost, and cost down average at the opportunity, instead of waiting years for that opportunity. Because, guys, to be completely honest with you, you saw I bought it in 2018. It hasn't even come close. They had record-beating earnings. They've had great product releases. They've had a stock split. I couldn't buy Apple if I wanted to at that price. If I bought it at my original price at like $185 or something like that, that was relative to like a 300 something, I think, like $340. So if you compare it to my average cost, it's still up compared to where I bought it. It's still up to where I bought it last year. So Apple's one of those companies that keeps climbing, and I'm not saying that it'll never drop, but I think I'm missing out on I think the opportunity. I think I'm missing out on a great opportunity by waiting, and so I'm just going to jump in and really take advantage when I have a cost on average opportunity. But as of right now, guys, I have 5 shares, $1,100 of almost $1,200 of market value. 209 is my average cost. It was 137. I'm not worried about it. We have 2% of the portfolio now in AbbVie instead of in Apple instead of half a percent. $24 we're up today. Total we're up 130 with a still 12.5% return, even near 52-week highs. So, guys, I'm still getting a market, like a market matching return here with Apple at these prices. So I'm just going to keep buying more. If people have an issue with it, they can tell me in the comments, but I like my strategy, and I understand that if I wait forever, or if I copied Buffett, I'd sell out. But this is why it's important to make your own decisions. It's important to be your own investor, have your own identity, make your own decisions, and your overall return will reflect that. I haven't been a perfect investor, but I do think I have a good sound strategy with Apple. And even if I have to, have smaller returns here in the short term, switch 12% for 70, I'm okay with that. So I love Apple, guys, and I'm going to keep buying more. And if you think I'm dumb, let me know down in the comments. But I think if I have, if I have a 12 to 20 share position, or even a 30 to 40, 50 share position, and I have enough cash to buy 20 shares on the side, or 15 to 20 shares on the side, I'm not worried, because I feel like overall, even if I buy at all-time highs, by the time I get to purchase at a lower price, I think it'll even out. Next up, we've got AbbVie at 168. We've got 95 shares, sitting at $15,900, almost $16K of market value. So, guys, this and excuse me, my colleague's talking again. That was a yawn. But guys, sitting at a third of the portfolio, right around where Altria sits at. Negative $74 today, up $6,900 with a 76% return on AbbVie. And so, guys, this is a complete flip from Apple. I will not be purchasing shares at these prices because my average is so low and it's run up so high. So if I had, say, 9 shares of AbbVie, I wouldn't mind buying it at these prices. But since I have 95 shares, it's a little bit different than Apple. But guys, I'm going to be I'm going to plan on just letting this grow. I would love to own 100 shares. I've even thought about purchasing a few more here, but I don't want my average cost to jump up that much because I've been stuck at like $150+ for a year. There's no reason to boost my average cost up by that much. So I'm going to let this keep growing. And just like I said with with Altria, this is just going to buy T. Rowe Price. This is going to help me buy more Visa. The dividends had a great growth rate. I'm happy to own 95 shares. They've really helped reduce the impact of Humira with their Skyrizi and other drugs that they've brought to the market. So even though there was a big, blip when they lost patent approval, I think that they've really helped themselves, and they've shielded the blow of the Humira patent. The Humira patent loss with Skyrizi. So I'm happy to own it. I'm happy to let it keep compounding and keep growing. Guys, when I originally bought this stock, it's kind of crazy with the dividend growth too. I don't talk about that enough with AbbVie. But when I bought it, 3-4 years ago, well, I guess like 5 years ago now, the dividend was $1.07. So the dividend's grown almost 50 cents per share. So, that's pretty significant from $1.07 to $1.55. That's almost a 50%, near 50% increase on the dividend alone, let alone the stock appreciation. So that's why this stock has been so great to me. And, speaking on Buffett selling Apple earlier, it's crazy because I bought the stock right around the time Buffett bought it and sold it. So in the time I've owned this, in like the 5 years, Buffett has said he wanted to own the big pharmaceuticals, bought this company, and then sold it within like a year. And he did make money on it, but he missed out on these returns. So that's, again, another really important thing, is just because I look up to Buffett, just because I follow, Berkshire's moves like quarter to quarter, I followed Charlie Munger, rest in peace, while he was alive. I still will follow his portfolio, and I still look at their quarterly updates and stuff like that. But just because Buffett sells Apple does not mean we should sell Apple. Just because he sells, something like AbbVie does not mean we should sell AbbVie. You need to have your own investment thesis with companies and follow it. You cannot allow yourself to be swayed by what some investors doing, because if I sold out when they did, I would have missed out on $1.55 per share on 95 shares. And the thing is, guys, that's the beauty of dividend investing too, is even if this stock price stays, at a level I don't want to purchase more, the dividend is still growing. So I'm still gaining passive income. It's still fulfilling my goals. So I love AbbVie. And it is a really important lesson to make your own decisions. Don't just follow somebody. Like Buffett's the greatest investor of all time. It might have looked dumb for me to hold a stock that he sold. But guess what? For me, it fulfills my investment goals. And sticking with it thus far has been very beneficial. So, it's okay to watch what they do, but don't copy what they do. And don't copy anybody on YouTube either. Just because I own AbbVie at 168 doesn't mean you should buy it. If I own it at 95 and you own it at 150 or something, doesn't mean you should sell it. So just keep your own mindset, keep your own investing goals in the front of your mind, and only act when it makes sense for you. Next up, we've got Visa, $266.88. We only got one share, so of course our market value reflects the stock price. Average cost is $268.29. 0.5% of the portfolio is in Apple. Today we're up $1.14. Total we're down $1.38. So guys, it is right around our average cost, a little bit below actually. Our average cost $268 to $266. So a small cost on average opportunity here for Visa. So guys, this is going to be one of the big pillars. I use my Visa card every single day. I swipe it, they process the transaction, get a small fee, and every time I swipe my card, I technically pay myself. And every Visa card owner that swipes billions of times a day pays me as well. Because, realistically, everybody probably uses their card a few times a day. Myself, just yesterday was my day off. We went to Half Price Books. I bought a book there. I bought gas. We went out to lunch. And then I paid for like Disney Plus or Netflix or whatever it was, the streaming service. So I swiped my card technically 3 to 5 times yesterday, and so times that myself times say 30 days in a month. I swipe my card probably 1,500 to 1,700 times a month. Times that by as many people that own a Visa card, you understand why they're making so much money. So I understand the business, I understand the fundamentals and the competitive advantage. Plus, this is the highest growth rate and best margin business that is in the portfolio. So Visa is going to be one of those big pillar companies. Overall, I want it to be the second biggest position in the portfolio, and unlike Apple buying at 52-week highs, this is actually below my average cost, so this would be a great place to put my money right now. But I don't have 267 right now to be thrown into the market, so I just have to be patient. This could easily turn into another situation like Apple, where even if it hits 52-week highs, I just purchase it, especially because, to be completely honest with you guys, I think overall I like Apple better, but as a business, as an overall business, I think Visa is actually better. And I think they are a bit overlooked when it comes to dividend growth investing. Then we got T. Rowe Price at near $119 per share. 100 shares, near $12,000 worth of market value. Average cost is $109, so we are doing pretty good here. 21% of the portfolio is in T. Rowe Price. Today we're up $88. Total we're up nearly $1,000 with near 8.5% return. So guys, I don't know why it keeps switching from AbbVie and stuff. I've noticed that in a couple of the other videos, but this is T. Rowe Price. So guys, this has a 50% upside. I've talked about it in past videos. Overall, I think the interest rate changes are what's really been affecting T. Rowe Price. And just like I said, with something like Altria, I think that I can analyze this business well enough to understand a hiccup versus a long-term business, like a fundamental change in the business. So I like T. Rowe Price. The dividend's growing at a smaller rate. That's why I would rather own Visa, to be completely honest with you. But T. Rowe Price serves its purpose. It brings in good cash flow. It can buy me about 2 shares of Coca-Cola. So it fulfills its purpose. It grows at a well enough rate that I'm willing to hold it for the long term, and I can take advantage when it drops. So, guys, overall, the theme of the portfolio is Altria is going to buy Apple, AbbVie is going to buy T. Rowe Price or Visa, and then T. Rowe Price is going to buy Apple. So this month buys next month. So Altria just paid me, and I bought some Apple shares with it. Next month, AbbVie is going to pay me, and I will either buy, if I have the extra cash in the portfolio, I'll buy a share of Visa with that AbbVie, Apple, and Realty Income dividend, or I'll buy T. Rowe Price if it makes sense. And then that next month, when T. Rowe Price pays me and Visa pays me, I will be purchasing more Coca-Cola. So, guys, the strategy's working. I just have to be patient and keep accruing more dividends and put that in the smartest place possible. Then, of course, we got Berkshire on the watch list, up big today. I'm not sure. I haven't seen any news on it, but I do think that it is a millionaire maker. This will be in the top 5 as well. And I honestly, guys, I talked about this in another video. I'm going to make it a yearly tradition. For every year that I've been in the stock market, I want a share of Berkshire. So even though it doesn't pay a dividend, I do understand a lot of the businesses that they own. The big one is insurance, but they also own BNSF Railway. They own See's Candy, Dairy Queen, Acme Brick. They own Dexter's Shoe. There's so many businesses that they own. Precision Cast Parts as well. Just Geico, National Indemnity, Westco. They own a lot of businesses. So honestly, they own Pilot now too. So they're a conglomerate. So they just have, in my opinion, I like Berkshire. I think it's the strongest insurance company in the world. And the big reason why I want to own them over something like Chubb, Travelers, Allstate, Aflac is because they have a little bit of insulation, of extra protection when it comes to their float. So even if they do a very good job at underwriting overall. But if they screw up, if they have a bad call when it comes to insurance underwriting, they have a multitude of businesses that they own 100% of. Plus, they have the cash flow from their dividend portfolio, from their publicly traded stocks that they own, like a bunch of Apple, Bank of America. They own a bunch of Chevron, Visa, MasterCard. They own just so many companies. I believe it's like 60 to 70 companies in their public portfolio, as well as like 75 plus privately owned, fully owned businesses that they can use to help with that insurance loss. So even if they don't make an underwriting profit, odds are overall, even with the fluctuation of economically within different businesses and different times within, like when they report earnings and whatnot, and what's going on with interest rates, overall government stipulations and interest rates, overall I think have a better, they have a competitive advantage and a better likelihood of writing good insurance due to who's running it. Plus, they also have, I think, a strong competitive advantage because they have those extra businesses producing cash flow. And I think that insulates them and keeps them a lot safer from bad underwriting or mistakes in underwriting insurance. So overall, guys, I'm just going to buy a share of Berkshire. So right now, 2018, 19, 20, 21, 22, 23, 24, I owe myself 7 shares of Berkshire. So I won't get that in probably this year, but I owe myself about three to $4,000 by the end of the year, like $3,500 worth of Berkshire Hathaway stock, to keep myself, even keel with the amount of time I've invested. So, guys, with that being said, let's wrap it up here. So we're sitting at $55K worth of market value. Overall, we have a 55 accumulated 56% return. And guys, I'm just happy. I'm happy to be investing, happy to stay invested, and I'm grateful to share my journey. I'm 28 years old, turning 29 in November. So realistically, I have 45-ish years to invest, and I know a lot is going to change in those decades. I'm sure the companies will change. My overall investing thesis might change a bit. Businesses might cut their dividend, go out of business, whatever. But regardless of what happens, I'm going to stay invested, and I'm going to stay true to this dividend growth investing strategy. So thank you guys so much for watching. Remember to hit the like button on my channel, hit the subscribe button on my channel, That Dividend Guy, if you guys enjoy the Monday through Friday content. Thank you so much for watching, and I'll see you guys tomorrow with another Robinhood portfolio update. Take care.